Welcome back to the Raw Selection Private Equity Podcast. Joining us today is James Varela, partner at Reed Partners. They're a capital raising firm. So today's conversation is all going to be around fundraising. We're going to focus a little bit on the Middle East, but in general perspectives of how you can raise capital from LPs in the Middle East, but also how you can improve your process, how you can improve your fundraising strategy to gain more capital and close faster and quicker. Let's dive in. Thank you very much for being on the podcast, James. James, if you can give us a brief insight into you, please.
Great. Thank you, Alex, for having me on. It's a pleasure to be here today. I'm James Varela, partner and head of MENA at Reed Partners. I started my career at Reed about 8 years ago, and prior to that, I've spent another 8 years in fundraising. So over 15 years raising capital for various GPs across a number of strategies, including private equity, infrastructure, real estate, and private credit. And now my role, I obviously look after investors across the GCC, but I also head up the teams that look after Switzerland and Southern Europe. And I also spend quite a bit of time looking at new GPs before we decide to work with them as well as part of our origination function.
Perfect. Discussion around fundraising. So if you can give us an overview of what the fundraising market is like today.
Well, I'm sure for a lot of your listeners are pretty well aware it's been a challenging fundraising environment for quite some time. I think we are seeing some green shoots and an improvement in that, certainly compared to a couple of years ago, but it has been challenging. And most of that is driven by a number of key factors. Obviously, macro uncertainty and the impact of things like, Russia, Ukraine, and tariffs, etc., have created uncertainty in the market. But in addition to that, one of the biggest challenges that investors are facing is lack of liquidity, lack of that capital returning to them from existing relationships and what we call DPI. I think we are always hopeful that this year will be better in terms of distributions, and that will hopefully open up more pockets of capital. I think it's taken longer than expected, and investors have just been cautious on deploying additional capital until they see that coming through. With that, we see a lot more focus on making sure that the relationships that are in portfolios are the right ones. And that's where we try and help LPs really curate the best portfolios that they can.
Do you think a lot of the, obviously there's the economic scenario at the moment. You mentioned Ukraine, obviously Trump tariffs, all sorts of things are creating hesitation, market fluctuations, etc. Do you think we'll need to see a lot of sell activity before, from private equity perspective, before we see more capital coming to the market?
I think GPs are getting very creative now. So I think you will have seen, and I've heard from some of your prior sort of podcasters as well, greater focus on using creative solutions to create liquidity, whether that's through NAVs and pref financing solutions or other liquidity mechanics that can be used, mechanisms that can be used today. I think it will take time until those distributions come through, and it's not gonna be a short term sort of next 3 months we're going to see a barrage of distributions. I think for most investors, they plan their allocations on an annual basis, so that really helps and try and pace their investment flows. I think this year for a lot of investors it's quite a heavy re-up year as well, so that will have a knock-on impact in terms of what they can do, new commitments for GPs. But yes, it's really down to getting that DPI up. And I think, for a lot of, I think I was reading the Bain report recently, 66% of LPs today really cite DPI as the key metric that they're looking at when looking at investing in new GPs. That has obviously shifted over time, and I think that's here to stay.
Awesome. And so talk to us about the kind of framework of a successful fundraise, from preparation through to, that big press release and telling everybody you've done what others are struggling to do.
Yeah, no, sure. So I think for our perspective, we like to work with GPs very early on. So often we start working with them about a year before a fundraising starts. It obviously varies depending on the situation, but the preparation phase is really the key phase if you want to run a nice, succinct, and swift campaign. And as part of that, you really need to develop an understanding of your equity story and ensure that it's really hitting the key points around what makes you very different, in terms of performance. If there are issues or challenges, how do you address that? And address it transparently for LPs. And in addition to that, I think, having that preparation phase and the time to really think about all these things properly is really important. I think as you get closer to fundraise, it's all about really targeting the right LPs, and that's something at Reed that we're very focused on. So actually, your return on time is really important for managing partners and senior professionals at private equity firms. They want to spend their time doing deals, not on the road, meeting with LPs. And so actually ensuring that you're focusing on the right LPs that are most likely to find your strategy resonates with what they're looking for is key. And then as you get into the fundraising part, I think, again, it really depends on the situation. Different GPs can run different fundraisers, and a lot of that is down to performance and other things. But if you can run a swift fundraise, a very structured process, that's great. I think what we find with our best GPs is, treating LPs, regardless of what your performance is, in the right way, with respect, regardless of ticket size, and helping them on the journey so that they have all the information that they need to make decision in an effective way.
From what are the if you see what's something you suggest to every private equity firm that they should change in their process, or you advise, or you go, look, guys, you should tweak a little bit of this? What are some of those things?
So what I would say is, I think often GPs have very good processes around a particular aspect of either value creation or sourcing, but they don't articulate it in a very systematic way. And what LPs are really looking for is, okay, how replicable is this strategy? How replicable is this process? And actually, often giving these things names helps, create a more systematic view of how they're doing things. So that may be around, the subsector thematic sourcing and how you go about that in a particularly nuanced way. It may be about particular aspects of value creation, whether it's, certain elements of professionalizing a business, or, the way you go about buy and build and integrating add-on portfolio companies, etc. It could be at human capital management, and I think often just finding ways to articulate much more clearly how you're doing that and how that can make a difference to the ultimate return that you're generating is really quite instrumental for a lot of LPs in kind of bringing things to life. And I think that the other thing I'd say to that is, you know, examples with actual proof points is really important. So, often I see GPs with a lot of theory, and that's all great. But actually, what LPs want to see is, how have you put that in practice, and how has that generated the returns that you've been able to successfully generate?
Okay. And from a kind of long-term credibility relationship, what do you suggest that private equity firms should be doing with LPs?
So I would say the first thing is, this is a very long-term asset class. As head of MENA, I obviously spend a lot of time with a lot of GPs that are looking to now capture capital in the Middle East, and often those GPs maybe haven't spent much time there in the past. I think you need to plan ahead is the key message, and really think about, you know, what do you want from your fundraise that's going to happen in 2 or 3 years' time, and what are the steps that you need to put in place today to be able to do that. So if I think about, my own experience in the Middle East, obviously co-investment is a really important part of what a lot of the larger sovereign wealth funds and larger investors, institutional investors, need and want to be able to make a commitment. Actually thinking about that 2 years in advance and thinking strategically around how you can use some of those levers to build relationships with some of those larger investors is really critical. A- and I think if you plan that properly and you lay the right groundwork, and to be clear, it's not about spending, a week there every 3 months and being in front of people. It's about the right content at the right time with the right people.
Okay. So, reference your context is predominantly focused around the Middle East, but how do you think private equity firms, GPs, should differentiate themselves from their fundraising process?
Yeah, I think that's a big question, and again, it's very much case by case depending on the GP and the strategy. But the overarching themes I would say is, what are LPs looking for first and foremost, beyond obviously performance and the key sort of hygiene factors, is really, why are you positioned to win in the particular market that you're in? So what differentiates you from the other 6 GPs that have been in my office this week, pitching their own funds? And I think you really have to kind of have a very introspective look at the firm and understand what are the real kind of key levers that that firm is particularly pulling, and bring that out in the conversation with the GP. I think the other aspect really, which is difficult for a lot of marketing focused individuals to grasp, is actually transparency and honesty. And no LP expects everything to go perfectly all of the time, and it's fine for things to not go right. I think you just need to articulate why they didn't go right and why you're well placed for that not to happen again. Um, and what are the lessons learned, and be very open and transparent about that. And LPs really appreciate that. And I always encourage GPs to do that.
The so if so when we say those kind of differentiating factors, is a lot of what you see and a lot of success you see from firms, because my kind of take on capital raising at the moment, mainly focused on the US lenses, that's where we do most of our business, but it's predominantly either it's horrible or it's fine, right? And that seems to be the general consent. There's nobody going, well, it was okay, it's just been, yeah, we've really struggled, or it's actually okay. Is a lot of that down, and being naive in that space, is a lot of that down to purely they're just better at, maybe not fundraising, but they've just got better from a process systems perspective. They've got better. They're better as a firm, and if we look at therefore produce better results, or is it more complex than that? Is that too simplistic?
Yeah, I think it's a good question. I would say, that's probably a little bit simplistic, although I would, actually a lot of the processes and procedures and systems in place actually help smooth out the bumps in terms of performance, I believe. So I think if you can have the right sourcing engine and sourcing model and make that replicable and consistent across the firm, particularly when we're talking about very large global firms that have multiple offices that are covering very different regions with very different cultures. If you can put in place a bedrock of and a framework that works for the types of investments and the types of deals that you're doing, hopefully you smooth out those investments that don't go so well, and kind of secure a stronger overall return. I think the other aspect is that comes into it is a lot of these things are unfortunately outside of your control, and you need to find ways to try and limit how out of control they are. So obviously vintage risk, deployment pace, equity ticket, all these things you can manage by putting in place proper portfolio construction. From a value creation perspective, if you're a firm that is doing a lot of buy and build, actually spending quite a bit of time focusing on how you integrate that buy and build is really important. And if you have a proper process around that, again, it just helps reduce risk. So I think a big part of what institutionalizing firms is about is really trying to use whatever levers you can within each of these different attributes to reduce the risk that something may go wrong or may go drastically wrong.
If I'm so we'll leave the guys that are fine in this market and raising capital, but if I'm in the struggling camp, how many firms do you, not as a number, but how generally do you speak to those firms? And generally you go, guys, you're probably going about this the wrong way. You've actually got a great product. You're probably just not selling it in the right way. You're not marketing to the right people. Is that fairly common, or is it actually, well, your fund performance has been bad, so I'm not surprised you're struggling?
No, I think it's actually very common, and in fact, it's even common amongst those firms that are doing very well. So often the performance is great, so you don't really need to worry about the story, and in those cases, that's fine. But also, we find you can actually much improve that story even further if you really think about what are you trying to do, and how are you going about doing it, and that takes a lot of brain power and effort. And if fundraisers have been easy, you've been able to raise capital in 6 months without any issues, always at the hard cap, you probably don't want to spend the time or invest the time today to to go through that brain damage because you don't need to. Um, but clearly where, performance is less clear, and we actually, sometimes like, working with groups where we actually think they're very differentiated and they're doing really interesting deals, and they have a real secret sauce, but there's a disconnect between the market perception of those firms and actually how good they really are. And often that's just down to how they tell the story. And with a few, quite uh, fundamental shifts in how you position certain things, it can make a real difference, and bring out what a lot of LPs might miss at a cursory glance because they've looked at the performance page and said, "Oh, that looks a little bit too much volatility versus some of the other things that I have on my desk." Um,
Sorry to interrupt. Just a quick mention of our long-standing partnership with Grata. As you will probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Grata provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Grata today. Now back to the podcast. So is a lot of that because I'm listening to this. I'm a big fan of a guy called Rory Sutherland, if you've heard of him, which
I
is
know Rory very well.
Emin of Ogilvy, and he kind of puts everything into a marketing lens and goes, "That sounds." I don't agree with him and everything, obviously, but that sounds a lot to me like it's a lot of a marketing lens for them. Is a lot of these firms just not knowing how to frame things, how to position things? Is that accurate?
Definitely. And I think, it comes back to my earlier point. You can be complacent if the performance is good. But Rory, and I recommend a lot of people read his book Alchemy. It's a great book. Um, he talks about it more in the context of Ogilvy and what he's done there. But if you don't need to change, you won't bother. And it's just a painful process to go through some of these things. Often we iterate things, um, 7, 8, 9, 10 times, with significant work going into the preparation to do that. And that's not easy to do. And, there's a risk, again, coming back to human nature and human behavior, change is just difficult. And if you're a firm with a 30-year track record of doing things in a certain way, actually trying to convince somebody to really shift the way you're positioning a particular firm, it's not easy to do. There's a risk with that. So, it is hard, but, often this makes a lot of sense for long-term success.
Do you think private equity firms, and this is just a guess really, do you think there's too much time spent on what the previous results is and not enough time spending on where the firm's going? Or is there something in there that you think there's maybe a challenge?
I think there probably is. I mean, look, when you're diligencing a fund as an LP, you have part performance to look at, right? So a GP is just naturally focused um, on how that looks, how you present that, etc. But I think a big part of it, and it depends again where a fund is in its evolution, is actually being able to position. Okay, what does this firm look like in 5 or 10 years time? And that's even more relevant in today's market where, you're seeing firms IPO, you're seeing a lot of extension strategies into various new areas that maybe a firm hasn't operated in significantly before. How do you articulate that very clearly to an LP that actually this is a firm that's going to continue winning, and also whilst they're scaling fund size over time, in a particular niche or a particular market where they built their original track record. And we see that a lot. And also with some of the larger firms that have now gone on to create sort of small cap or mid cap strategies, essentially going back to their knitting with some of those strategies and being able to capture that part of the market again as well.
Okay. So capital raise is an international game. Your focus, you mentioned that kind of Middle East um, region. What are some of the, but obviously every region has its nuances in how capital is pitched and how funds are raised. What are the common mistakes that P firms are making when they're pitching to Middle Eastern LPs?
Well, I think, there's a few things that I would kind of bring out, and, one, the Middle East is a region that has got a lot of attention right now, particularly as capital raising is challenging in other market. Uh, you know, in the US and Europe, denominator effect in some cases, and those larger investors have struggled to be able to deploy the same amount of capital that they were deploying a few years ago. It means that in a lot of cases, GPs feel the need to spend too much time in the Middle East often. And I was speaking to one of my investors the other day, and he said, "Look, I have 50 GP requests a week to meet. I can't do that and then do my day job." And I think the key thing is actually thinking about when is the right time to go to the Middle East? When is the right time to spend time there? Yes, it's important to build relationships over time, but there isn't any point in going there every 3 months to regurgitate the same story again and again and again to the same people. So when there's portfolio news, when there's portfolio events, use that as a catalyst to have a conversation. I think there's two elements to the GCC generally, and again, there's cultural differences between different countries within the GCC. It's obviously a large region. A big part of it is actually understanding, yes, there is a relationship element, and that's important, and you need to build that over time. You need to be patient, and you need to have a long-term mindset. The other aspect is it can be quite transactional, particularly with some of the larger sovereign wealth funds and institutional investors, where, as I said before, co-invest is just a big driver of decision making. They want to do more direct deals. And in order to be able to do that, they want to get access to the most interesting co-invests. And these are often sizable co-invests. So when you do have that, think strategically around how you might be able to use that to catalyze some of those relationships. That's really important. Um, Again, coming back to the earlier point around transparency and honesty, I think it's really important that yes, you celebrate your successes, but you also talk about, what have been the challenges, what hasn't worked, and what is your vision for the firm longer term? How are you going to be the right partner for these LPs? Uh, and then I think the final point I'd make is, it's just a very competitive environment. You're not going to win them all, so you need to think about, again, the targeting aspect of really understanding who you're going to see and why you're going to see them. And again, that's something we spend a lot of time on. So it's great to go and see all the investors that you read about, but often a lot of them are just not going to be relevant for you. And Middle Eastern investors are looking for most are looking for a very specific product. And so I think if you can show them that you understand what they're looking for and that you can deliver that consistently over time, then that's going to make a big difference to your chance of success.
Okay. And you mentioned that the Middle East is looking for a product. I'm sure everything's very diverse with regards to the aspect of interest. Where do you see a lot of, just looking at this from a private equity lens, where do you see the particular interest from the Middle East from an LP perspective or the most investment going? Where do you see it now? But where do you see that kind of trend, crystal ball type work over the next 3, 5 years?
Yeah. So I think the generalization I would make for most investors in the Middle East is that their portfolios are heavily tilted towards North America. So most investors invest roughly 70% into North America, 20% into Europe, and the remainder into the rest of the world. The vast majority of investors are looking for large brand names, so the kind of 2 billion plus funds, and often these need to be fund three, fund four onwards. So they want to see a proper track record. Emerging managers is just very challenging unless you come from a firm that they know very well and can diligence that track record very easily. And then again, coming back to co-invest, important that they see a path to significant and sizable co-invest. And these are often 50, 75, 100 million plus co-invests. So that's a general perspective. Obviously, there are nuances. There are a few family offices that do smaller, more niche things in the lower mid market. There are some that will do just mega cap, ultra mega cap, etc. But that's a generalization. Then as far as strategy sectors is concerned, generally there is a tilt towards more value complexity type strategies. And today we're seeing greater focus on specialization. So again, this has been a bit of a journey, but if you're telling me what are we looking for in the future, I think it's more specialism from a sector perspective, and even within that, from a subsector perspective. Um, the UAE in particular, but other countries are in the GCC are very focused on AI and technology. And again, if you can bring interesting investments in that space to bear, then that's something that's of particular interest. And in addition to that, what I would say is overall, the performance needs to stack up. But if you can hit a lot of these other things, you start to get in the realm of what most groups are looking for. A lot of the larger sovereign wealth funds, etc., are focused on a sector basis. So you need to target the right sector teams with the right investments in order to unlock. And then the other trend that we're seeing more and more is appetite for GP stakes. So I think most Middle Eastern investors realize that their capital is very valuable in a market where liquidity is constrained, and actually, in addition to the co-invest and having a great funds that they can invest in, they're looking for more tactical opportunities to make sure that capital goes even further through acquiring GP stakes and other means.
Awesome. Thank you very much for those insights. But interesting to see the allocation percentages with being heavily weighted in North America. That's incredible. Do you think that's going to continue?
It's a good question. I think it will, although the other thing we are seeing is Europe is increasingly becoming more relevant. Again, part of it is also the size of players and the size of the market.
Yeah, yeah.
But I think that will tilt a little bit more towards Europe. I think, historically, a lot of the LPs in the region have done the very large global funds. And the other trend that we're seeing is just greater focus on moving down the stack more to the mid-market, and in some exceptional cases down to the lower mid-market. So as that happens, I think it'll open up a broader kind of geographical diversification and increase the European part of the bucket as well.
Yeah. Some options for Europe as it brings it back.
Yeah.
Interesting. So you read it. You referenced Rory Sutherland and Alchemy as a book, as something you've read. What else do you read, watch, listen to? Do you recommend that others check out, please?
So I enjoy podcasts a lot. So I travel a lot and enjoy listening to podcasts when walking through airports and things. I think this, obviously, beyond this podcast, the Acquired podcast I really like. So two things I'm really interested in. One is other businesses and what makes them tick, and the Acquired podcast is great for that. I also like Diary of a CEO. One of the things I really like is just understanding people and what makes them tick. And although that's a bit more easy listening, it's just great to get a broader perspective beyond just private equity and private markets. Um, what I like to read, lots of books around the industry and business and leadership. So one of my favorites is a book called Tools of Titans by Tim Ferriss, who I really like. It's really a compendium of uh, life hacks for a lot of high performing individuals. So what they found really works for them in terms of getting those incremental gains. That's a great book. And then there's lots of other great ones like Atomic Habits by James Clear as well, and Thinking Fast and Slow by Daniel Canahan, and good books like this. I try and consume at least one of those a month if I can.
Perfect. Yeah, I'm a big reader myself, so some of those I've ticked off. Some of them I'll be looking into. If somebody wants to reach out to you, James, how best they get in touch, please?
Sure. So best way is probably through LinkedIn. So you can find me at James Varela. That's Varela. Or alternatively, you can also email me at james.varela@reed-partners.com.
Perfect. Well, thank you very much for coming on to the podcast, James, giving us your insight into the world of fundraising. As I said, it's either a hellish nightmare at the moment or something that's okay, it's gone all right, we've got it done, and on to the next one. So appreciate your insights and your guidance for private equity funds to improve on this.
Thank you very much, Alex. It's been a pleasure to be on with you.
And as always, thank you very much for everybody tuning in yet again to the Private Equity Podcast. If you haven't done so already, please do subscribe and you'll be notified of the next podcast as it comes out every single week. But till the next time, keep smashing it and thank you very much for listening.